Welcome to RichTrybe. You know, I've spent years navigating the financial landscape, and if there's one thing I'm absolutely obsessed with, it's breaking down the real mechanics of wealth generation. Not the flashy, superficial stuff you see all over social media, but the proven, structured methods that actually build lasting financial freedom. Today, we're going to unpack exactly how to structure your assets to transform your everyday income into true invisible wealth. Let's dive in. Now, here's a question that completely shifts how you view money. Why do so many high earners often end up with zero true wealth? We've all seen the illusion, right? The person with the senior vice president title, the brand new Tesla in the driveway, the $800 sneakers. They look exactly like the millionaire next door.
Right, but the data tells us a completely different story, doesn't it? Many of these high-income earners are actually living paycheck to paycheck, totally trapped by their own spending habits.
Which brings up this quote, "Wealth is what you don't see." But Richard, what does that practically mean? If I can't see it, how do I even know it's there?
That is exactly the point, Rachel. Real wealth isn't the luxury car you bought. It's the luxury car you explicitly chose not to purchase. True wealth is the capital sitting quietly in an investment account. It's compounding in the background, working 24/7 without you lifting a finger, purely to buy you the ultimate luxury, which is your freedom.
And that leads us perfectly into section 1. Income is not wealth. Let's talk about PAWs versus UAWs. In the financial literature, there's a fascinating way to measure this. We look at prodigious accumulators of wealth, what we call PAWs, versus under accumulators of wealth, or UAWs. A PAW is someone in the top quartile who's accumulated at least twice the level of net worth expected for their age and income. A UAW is in the bottom quartile, with half the expected net worth. This mathematically proves that a massive salary just doesn't automatically equal a high net worth. It's about what you keep, not what you make. So looking at this, we're comparing a high-income focus, which is really just chasing instant gratification, versus a high net worth focus on acquiring investments. Is failing to save really just a massive ego problem for most people? Fundamentally, yes. Look, everyone needs the basics to survive. But once those are covered, you hit a level of comfortable basics. Past a certain income level, the spending you see is almost entirely driven by ego. It's consumerism designed to signal status. And every single dollar spent feeding the ego is a dollar drained right out of your potential investment capital. This requires a massive pivot in how we think, which brings us to section 2, consumer versus investor, the mindset shift. Wow, this comparison is just staggering. If I spend an extra $1,000 a month on premium vehicles or the latest electronics, I'm buying depreciating assets. After 30 years, the remaining value of those items is basically zero. I literally have nothing to show for it.
Exactly. But if you take that exact same $1,000 a month and redirect it into appreciating assets, like an S&P 500 index fund averaging, say, a 9% annual return, through the power of delayed gratification, that same monthly cash flow turns into approximately $1.78 million over 30 years. That is what financial independence looks like.
So how do we actually build that? Let's get into section 3, the core foundation and modern portfolio theory. Okay, so to hit that $1.78 million goal without taking on catastrophic risk, we use a core satellite asset allocation. It's a hybrid strategy combining a large, stable core of passive investments with a smaller satellite portion of active tactical investments. But how does this actually look in a real portfolio? Is it super complicated to set up?
Honestly, it's incredibly elegant in its simplicity, Rachel. This is exactly how millionaires balance risk and long-term expected returns. You're essentially building a massive, highly efficient engine that drives the bulk of your wealth reliably, and then you're just bolting on a smaller high-performance booster for extra growth.
Visually, your portfolio is split. This massive 80% green section is your core foundation. This is what provides your stability, capital preservation, and steady compounding. It completely protects you against market volatility. Then, that remaining 20% gold section is your satellite strategy. This is where you allow yourself to take calculated, opportunistic risks for higher growth. To ground this 80% core in the real world, you're basically building a diversified asset base piece by piece. This core is heavily weighted in passive investments. We're talking about incredibly efficient broad market index funds and ETFs. We're talking tangible real estate that appreciates and spits out rental income, and solid fixed income securities like municipal bonds. These are the assets you can comfortably leave alone to just compound for decades. Right. Which brings us to section 4, the satellite strategy. Let's talk about those active, tactical bets. Let me play devil's advocate here because I know a lot of people watching are thinking this. The core requires a lot of passive patience. But Richard, if I only have a little bit of money, shouldn't I just actively trade everything to try and get rich quicker? Like, why settle for 9% when I could potentially double my money on a hot stock?
Oh man, that is the single most common trap for average earners trying to build wealth. I get it, it feels so intuitive, but the math and the data violently disagree with that approach.
The main reason you don't actively trade your entire portfolio comes down to cost and tax efficiency. Your core passive investments, like those index funds, are highly tax efficient and have incredibly low management fees. Active trading, on the other hand, that triggers massive capital gains taxes and incurs heavy trading costs. Academic studies continuously show that active management struggles to consistently beat the market over the long term just because of those frictional costs. That is exactly why active trading has to remain a smaller satellite. Now that 20% satellite portion, that is where you do take those active, short-term, opportunistic bets. This is where you allocate capital to high-yield business opportunities, individual stocks you really believe in, or alternative investments like commodities, private equity, or digital assets. These are often 0 to 12-month trades. You use the satellite to try and generate alpha, excess returns, without ever jeopardizing your 80% financial foundation. Navigating this risk-return trade-off seems like it requires an immense amount of psychological discipline. You really have to keep the two strategies completely separate in your mind.
You absolutely do. Behavioral finance shows us that without discipline, investors fall into massive traps. One big one is conservatism bias, where you irrationally hold on to losing satellite investments just because you don't want to admit defeat. Another is emotional panic selling during market dips. By strictly adhering to that 80-20 core satellite rule, you actually protect your portfolio from your own worst emotional instincts.
Now, before we reveal the exact daily habits you need to actually fund this incredibly powerful system, make sure you subscribe to the RichTrybe channel. Like, comment, and share this explainer. Seriously, our goal is to empower as many people as possible with this kind of foundational financial literacy. All right, let's get into the application. Section 5, Daily Wealth Habits, because execution is everything. How does the average earner actually find the excess capital in their everyday life to build out this portfolio?
It all comes down to 3 non-negotiable steps. Step 1, treat your savings like your absolute most important utility bill. You pay yourself first, before the rent, before the groceries. Step 2, automate it. Willpower fades, but systems stick. Set up automatic transfers so the money moves to your investment accounts without you lifting a single finger. And step 3, spend with deep intention. Before you buy, just pause and ask yourself if this purchase aligns with your long-term priority of freedom or if it's just a fleeting impulse.
To really accelerate this process, you need tactical awareness. Check your accounts regularly so you know exactly what is going in and out. Crucially, redirect any found money, like an annual bonus or a tax refund, straight into your core foundation. Do not inflate your lifestyle. Cut out the small, silent wealth killers, like unnecessary bank fees and unused subscriptions. And finally, work with a professional financial advisor. Having a pro align your goals significantly boosts your confidence and helps you avoid some really costly missteps. So, summarizing this entire journey, true wealth isn't about looking rich today with depreciating consumer goods. It's about executing a highly structured 80-20 core satellite asset allocation plan consistently over time to literally buy your freedom for tomorrow.
Perfectly said, Rachel. It is consistency, not luck, that builds ultimate financial freedom.
Which leaves us with one final provocative question for you to ponder today. Are you ready to stop acting rich and start building invisible wealth? The blueprint is right here in your hands. It's time to redefine your financial identity, shift from consumer to capitalist, and let your capital finally start working for you.